All businesses need access to money in order to survive and grow, but where can they get this money from? Let's explore internal and external sources of business finance. Internal finance is money that comes from inside the business. It's a quick, easy, and flexible way of accessing money, but there may be a limit to how much is available. A business can use retained profit as an internal source of finance, reinvesting its profits that it made in the previous year. Or it may decide to sell off spare or unwanted assets to raise a one-off sum of cash. This isn't a long-term solution, as there will be a limit to the number of assets that can be sold. Business owners may decide that they need to look outside of the company to raise money. This is called external finance. They may choose to borrow money from family and friends, or go to a bank or other financial institution and ask for a loan. The loan will have to be paid back, often with interest, over a specified period of time. Businesses often use overdrafts as a short-term form of finance, allowing them to cover small day-to-day payments. If a business is a limited company, then more shares can be sold to raise finance. Although the more shareholders there are, the less control the original owners will have. Some businesses could qualify for government grants, which they won't have to pay back, although they may have to follow strict rules on what they can use the money for. If a business needs to purchase supplies, it could use trade credit, meaning that they can pay their suppliers at a later date. This will free up more cash to use in the immediate future, but it is important to keep track of what is owed. Finally, if a business needs to buy an expensive item, like machinery or a vehicle, they could use hire purchase. This is a finance agreement following an initial down payment. A monthly amount, including interest, is made until the total cost of the item has been repaid.